Good morning. Welcome to the weekly market wrap-up. The markets ended the week in the red after seeing a massive sell-off in the market. The key indices Sensex and Nifty were both down 3% for the week. All sectors except auto saw correction and selling was seen in energies, utilities and PSU banks which corrected the most. The sell-off was mainly triggered due to the fall in 7 out of 10 Adani stocks, which were down almost 5 to 20% on back of a report from foreign research firm called Heidenberg, which raised concerns and highlighted the over leverage taken by the richest man in Asia. Towards the end of 2022, there was a mega price discovered rally in the PSU banks. The Nifty PSU index has become the poster boy for value investors, but the sector saw some major corrections in the week gone by. The sector has become a crowded trade, which rarely performs, and we believe better or even a further correction is pending in this sector. Coming to the main highlight for the coming week is the budget. The union budget will be presented on Wednesday, the 1st of February. As the budget approaches, there is usually a lot of speculation and anticipation among investors. However, this year, the buzz around the budget has been relatively missing, partly due to the bearish momentum in the market, and the Indian market continues to look fragile on the back of FII selling and weak Q3 earnings. Consensus says that the budget will have a balanced approach towards fiscal consolidation and economic growth. Tweaks to capital gains tax will also be keenly watched as it has been raised as a concern by many economists. The budget could stay geared towards improving living standards of the poor as well, while continuing to build on necessary infrastructure like roads and highways. The fiscal momentum post-COVID is expected to remain a core theme in FY24 budget. The fiscal deficit number will also be a closely watched number. In line with the past trends, we do not see any significant rally or movement in the market, and this can also be seen visible as you are seeing the corrections happening in the market. The revival of private capex is also clearly visible as L&T has won its biggest private capex order in the last 4 years, helping it to sustain its backlog of double digit. The FY23 budget expenditure is going to be around 7.5 trillion, and we could see a major bump up in capex of around 10 to 15%, bringing the total expected budget costing to around 8.5 trillion rupees. Being the penultimate year before the elections, we expect the government to boost sectors like agriculture, rural infrastructure, as we are seeing that rural demand is still to pick up the pace. So the four main things to closely watch during the budget will be the nominal GDP growth target and the gross borrowing number. Since typically in a pre-election year, more expenditure oriented and less privatization is seen as the trend. In FY24, other thing to look out will be the growth number, as we see a growth slowdown likely and the pent-up demand fading post COVID lockdowns. However, a low GDP growth number is expected as major countries are facing recession. Fiscal consolidation is also going to be another important factor going up, and we would like to see how the government brings up its fiscal deficit numbers, which are expected to be around 6.4%. Coming to the next theory which I would like to talk about is how to invest into dividend yielding stocks and how high dividend yielding stocks could be the best option during a falling market. So high dividend stocks don't lose their value even if there is a sudden market crash or decline in a particular stock. As a result, they are safe compared to high growth stocks. These stocks, when added to the portfolio, help to diversify your risk potentially. Higher dividend yield stocks, especially in oil, gas, power and energy sectors, have outperformed the benchmark Nifty index handsomely by 24%. with average stock price appreciation of 4.8% plus a high dividend yield of 12.9% so far this year compared to 11.3% fall in the Nifty index. Coming to the underlying theory behind this high dividend yield stock is the dogs of Dow theory. Now, this theory basically says that it attempts to beat the Dow Jones Industrial Average Index by leaning towards high dividend yield stocks. The general concept is that to allocate money to the 10 highest dividend yielding stocks out of the 30 in the Dow Jones, and it requires rebalancing at the beginning of each year. The strategy attempts to basically maximize the yield of investments by having the high dividend yielding stocks. The strategy's track record shows that it beats the index during a 10-year stretch after the global financial crisis. So this means the companies with a high dividend relative to the stock market are near the bottom of the business cycle, so their stock and price likely would increase faster than the companies with low dividend yield. In this scenario, an investor investing in high, or rather reinvesting in high dividend yielding companies annually would hope to outperform the overall market. High dividend yield stocks, in our opinion, can be a great player to invest in a downturn in the market. For investors looking to protect their capital, a high dividend yield in high dividend yielding company annually would outperform the overall market. But we have to be cautious that companies can also start and stop paying dividends at any time. So it's important not to take false security from these kind of stocks. That's it from the weekly market wrap up. Have a nice day.